Good afternoon, everybody, and thank you for joining us today. We want to thank you for spending an hour of your Valentine's Day with us. Before we jump into the presentation, just a couple of quick tech tips for you. First is we want to make sure you have a great viewing experience. So we want to make sure that you can view the webinar today in full screen. So just a couple of tips for you. If you run your mouse across the top of your screen in the right-hand corner, you'll see a view icon. So if you click on this small icon in the top right-hand corner, a drop-down menu is going to show up. And we'll want to make sure that at the top you've selected standard, and then at the bottom you've selected full screen. And then second, just as we have in past years, we're going to keep the everyone's line muted just so we can block out any background noise. But we definitely want this to be interactive. So we want to encourage you to ask questions today through the chat box in the Zoom app. If you don't see a ribbon or a menu across your screen like you see here on our slide, just go ahead and pull your mouse towards the bottom of your screen, and this menu should pop up. And right in the middle there, you'll see the chat icon. Okay, so if you just want to click on that chat icon, a little box will appear and you can type your question in and that'll come to us. We'll stop multiple times throughout the presentation today to answer questions. So no need to wait. Just go ahead and enter your question whenever you have it, and we'll make sure and address it when we get to a break. So finally, we'll be discussing past performance of the funds we use today. So we want to make sure that everyone remembers that past performance is no guarantee of future results. On our agenda today, we have a number of members of our advisory team that we'll be sharing with you today. James, Jake, Lavia, and Katie will all be participating in the webinar today. We've got it broken down into kind of 4 key themes today. One is we're going to give you a business update on some of the happenings at Aspen Capital Management over the last year. Then we'll go into some historical investment performance we think you'll find interesting. Then Katie's going to give you some thoughts on the current market. And then Lavia is going to talk a little bit about where do we go from here. Before we jump into performance, just a little update on our team and some of the things that have been happening at Aspen Capital Management. So the last few years, we've told you that we're committed to building a firm with multi-generational talent that will benefit our clients in multiple ways. Having a multi-generational team will not only allow us to serve our clients throughout their lifetime, but will also be a resource for their children when they have financial planning and investment needs. As both our clients and our advisors age, it's important to us that you'll never need to find a new advisory firm to work with. In addition, the growth of our team gives us the added capacity to continue to be a resource to your family and friends. We're a team of people who love to help others, and we've designed an organization to make sure our team is always available when you, your family, or your friends need help. Now, on this screen, you'll see that we've added a couple of new people over the last year. In the very bottom right, I want to call your attention to Nate Berman. Nate joined our team last summer on our operations team that's headed by Rachel Rant. Nate's going to be working on all of our trading and cash management. We've consolidated that activity in our operations team. And so many of you that are clients will have an opportunity to, if you haven't already, to interact with Nate in the future, as Nate's really the one that's primarily responsible for moving money in and out of client accounts at TD Ameritrade. And then just above Nate, we have Trevor Hotmer. Trevor joined our team last summer as well as our first intern. Trevor is in his senior year at Boise State. He joined us full-time last summer, supporting our advisory team and working closely with Livia Thomas. And Trevor's agreed to, he's been working part-time for us through his senior year, and Trevor has agreed to join us full-time in May when he graduates. You recently got an email from us, maybe 2 or 3 weeks ago, talking about some of the just fantastic academic accomplishments of our team here over the last year. Lifelong learning and intellectual curiosity are part of our core values at Aspen Capital Management. Not only are they encouraged, but we enjoy celebrating the continued educational pursuits of our team members. Another of our core values is to employ driven, self-motivated people with a passion for providing clients with a best-in-class investment and financial planning experience. Last year, the 4 team members on our screen made substantial personal sacrifices in pursuit of both of these core values. Katie Dow at the top. Last year, she completed her master's degree in financial planning through Kansas State University. Katie worked full-time. She's a mother of 2. She gave birth to her second child and completed her master's degree in 2 years. In the middle, you'll see Jake Taylor and Livia Thomas. Jake and Livia both spent last year in a strenuous program to receive their certified financial planner designation. This is the highest and the most coveted designation in our industry for financial planning excellence. And then Nate Berman at the bottom. Nate last year completed level 1 of the Chartered Financial Analyst designation. Very similar to the CFP, the Chartered Financial Analyst is the most difficult and the most well-respected designation for financial analysts in the financial industry. It's a 3-level program. Nate completed level 1 last year, and he'll be sitting for level 2 in May. So if you're chatting with Nate here in the next month or 2, wish him good luck. Now, this morning, many of you received an email from me, and I've had my email replies have been swamped today with congratulations for both Katie and Rachel. I mentioned earlier our commitment to building a multi-generational firm. This can only happen if we broaden our leadership and ownership team. And I'm incredibly excited to announce today that both Katie and Rachel have expanded beyond our leadership team to become partners and owners in the business on January 1st of this year. This is only our first step in expanding the ownership of the firm long term, but I'm thrilled that Katie and Rachel are going to be my first 2 partners. They're both incredibly talented and driven people, and they've each played a key role in the growth of the firm the past 4 to 5 years. Their fingerprints are all over our internal processes and the services and advice we provide clients. Rest assured, we would not be where we are today without the ideas, the professionalism, and the work ethic of these 2. Katie and Rachel's willingness to make a substantial financial commitment to the firm is yet another step in Aspen Capital Management, ensuring we have multiple generations of leadership talent that's committed to serving our clients in the future. So if you interact with Rachel or Katie at any point here coming up in the next couple of months, if you haven't already, please take a minute and just congratulate them and thank them for the work that they do on behalf of all of our clients. So with that, I'd like to turn it over to Jake, James, and Livia to talk more about some important updates you'll want to take note of for 2023.
Thanks, Mike. For our important 2023 updates, we're going to be talking about some changes to contribution and gifting limits. We're also then going to jump into our lower mutual fund fees and some changes we've seen to fund fees. And then Livia is going to wrap it up with some changes and updates on the Secure Act 2.0. First off are some important 2023 tax updates. There are a number of important updates for 2023, and as you all likely know, many of these tax-related brackets and incomes are linked to inflation. Given the inflation we've seen in both 21 and 2022, there have been large back-to-back annual increases. Looking at this chart, you'll notice on the far left column some of the most widely applicable limits to those of you on the webinar today. In the middle columns, we have the 2022 and 2023 figures. And then on the far right, the change. The first four limits highlighted here by this star, this number one star, are related to retirement plan contributions for both individual and employer plans. So for those of you contributing to a 401k, which you'll see here are the second and third options on this tax limit chart, your 2023 contribution limit is $22,500, or if you're over the age of 50, it's now $30,000 for the year with that catch up. So that represents a $2,000 and $3,000 change respectively year over year. The next four here, highlighted by the second star, are all related to the standard deduction for both individual tax filers as well as married tax filers. So what you'll see for individual taxpayers is that in 2023, taxpayers received an increase of $900 to their standard deduction to $13,850. And for those who are married filing jointly, you now have a standard deduction of $27,700. And if you're over the age of 65, I just want to draw your attention to those two columns below where you can see the standard deduction limits for 2023. Lastly, this final category highlighted by the third star is around the annual gift exclusion. In 2023, you can gift up to $17,000 to any individual you like without impacting your total lifetime gift exemption. So this is applicable for many of you as well as those who are married and gifting up to now in 2023, $34,000 to any individual without impacting the total lifetime exemption. So there are a number of other tax changes for 2023 that we're not going to jump into today. But if you have any questions, reach out to your advisor and we're happy to talk it through with you. Remember, these tax limits are not only important because of your tax bracket and rate, but they can also impact your Medicare premiums, eligibility for certain contributions, and then also tax credits that you might be eligible for. Now I'm going to pass it over to James, who has an update on the fund fees.
Thanks, Jake. And before I jump into that, it looks like someone was able to draw on the slide. So we're going to try and stop sharing our screen and resharing just to clear that off. So bear with us for just 1 second. Perfect. There we go.
Well done, James.
Thank you. So as Jake said, I'm going to talk a little bit about management fee reduction, and I have some more good news here in this area because some of the funds that our clients own will further reduce their management fees at the end of this month. To elaborate on this just a little, ETFs and mutual funds charge investors a management fee in order to be invested in the funds and to get exposure to the market. They charge a small percentage of the amount you invest with them. The data shows that funds with above average fees are highly likely to underperform the market over time. That's why you always hear our team focusing so heavily on investing in low-cost funds. In fact, the investment funds that we use for our clients are in the very bottom quartile for management fees. For a handful of the funds we use, these low-cost funds are getting even cheaper. Most of our clients own investment-grade fixed income and global real estate, which are both seeing a 0.01% decrease in the actual fee. Some of our clients own global sustainability fixed income, which is seeing a 0.02% decrease, and short-term extended quality fixed income, which will have a 0.01% decrease. These reductions represent a continued trend where our clients have now seen fund fee reductions 4 times in 4 years. And actually, the core funds that most of our clients own in their portfolios will have now seen on average a 38% decrease in management fees since 2011. So this is great news for our clients. They're all benefiting from this. Now for our last update, Livia will take a minute to touch on a recent legislative change referred to as the Secure Act 2.0.
Thank you, James. Secure Act 2.0. You may recall this was the highly anticipated but very underwhelming result of the recent legislation. There was a change that impacts some of you and may offer planning considerations this year. There were also several proposed changes that didn't happen. Let's start with what did change, which is the RMD age. First, nothing changes for people who were already taking RMDs. If, however, you turn 72 years of age this year, 2023, you will wait to take your RMD in 2024. Finally, if you were born in 1960 or later, you will wait until age 75 to take your RMD. This is actually a planning opportunity for those of you who will be taking your first RMD in 2024, because you now have an extra year to utilize the Roth conversion strategy. Please remember to work with your Aspen Capital Management advisor on the analysis for this toward year end in conjunction with your tax professional. History has shown, and we assume the future will as well, that members of Congress are notorious for proposing vast sweeping changes that historically do not actually pass. We use a technical term to describe this. It's a head fake. And as you can see, head fake 2022 kept with tradition by not changing many proposals. This shows a list of many of the original most impactful proposals of the Secure Act that did not actually pass.
Thank you, Livia. So I'm going to take just a minute and share with you some past performance. And I promise this is a good news, bad news story. Everyone's aware of the bad news from last year. And what I'm showing you is 2022 benchmark index returns across the major asset classes we invest in. They're all negative, they're all red. Global equities and real estate on the right-hand side of the graph were down anywhere from 15 to 25%. That's not a level of volatility that's foreign to equity investors, and certain a level of volatility that we expect every 5 to 10 years historically. The outlier last year was bond performance. On the far left-hand side of the graph here, down 13%. If we look at this historically, this was only the second time in the last 100 years that we saw double-digit declines in the U.S. aggregate bond market in the last 100 years. So while equity performance last year was unexpected, bond performance was unprecedented. Now, Katie's going to talk more about our thoughts on each of these areas going forward. But while this data is interesting, we thought it would be even more beneficial for you to understand some of the really interesting dynamics taking place below the surface in your equity funds. As you might remember, your different global equity funds begin by owning the whole of the market in a low-cost way. And then the portfolio is tilted towards three dimensions that historically have increased returns. Those tilts are towards value stocks, small cap stocks, and more profitable companies. And in just the past 5 to 6 years, we've had a very interesting case study in the value premium. So we thought we'd give you a deeper understanding of how the value tilt has impacted the returns of your portfolio over this last 5 to 6 year period. Before we jump in, let me remind you how we define value and growth stocks. because what you're looking at on the chart shows you the roughly 100-year historic performance of value stocks represented by the blue bar and growth stocks represented by the green bar. And you can see that value stocks have outperformed growth stocks by about 3 percentage points over the last 100 years. So how do we define each of these? A growth stock is defined by a company that has a high market capitalization. Okay, that is to say that the total value of the company is quite high, which historically is likely going to lead to a company whose recent stock price performance has been quite strong. And at the same time, they have very few assets. Okay, so a great example over the last few years of a growth stock would be a company like Netflix. Their stock prices had performed exceptionally well, meaning that the market capitalization or the total value of the company was quite high. But at the same time, Netflix has very little assets. They have desks, they have some computers, they have some servers, but they're very asset light. On the flip side of the coin, a value stock would be a company that has a lower market capitalization or maybe a declining market capitalization with a lot of assets. So a good example of this, if we go back to 2020 during COVID, when oil prices cratered, so too did the stock prices of oil and gas companies. So if you took a company like ExxonMobil or Chevron, right, their market capitalization had declined substantially, but they were companies with a large amount of assets. That's a great definition of a value stock. Now, you might remember that at the end of 2019 or the beginning of 2022, we were explaining to you what had happened in the market. And you can see for that 3-year period ending in the summer of 2020, growth stocks had noticeably outperformed value stocks. And in fact, this was the widest 3-year margin of growth stock outperformance versus value stock that we've seen in history. And at this point, we were explaining to you that this was due to the rapid rise in just a handful of large cap growth tech companies. These were known in the press as the FANG stocks. And FANG stood for Facebook, Amazon, Apple, Netflix, and Google. And those 5 companies' stock prices had grown substantially, driving the aggregate performance of growth stocks. And we also at that point showed you a chart that looked something just like this. So what we're graphing for you here is the historic nearly 100-year valuation of value companies versus growth companies. So on the vertical axis, we're using that same metric that we talked about before, the price to book ratio. And the blue line at the bottom shows you that historically value stocks have traded at about 1 to 2 times book value. And the green line is the historic valuation of growth stocks. They've historically traded, although they're much more volatile, their valuations are than value stocks, they've traded at about 4 times book value historically. But by mid-2020, at the very end, at the very far right on this graph, growth stocks were trading at really their all-time high, right about 12 times book value. And most notably, the spread in valuations between growth and value stocks had widened to its widest margin ever. And you may remember in our reviews where we shared this very data with you and encouraged you to be patient. There was no reason to believe these historically high valuations would last forever. And in fact, they didn't. As you'll see on the far right here, in that 2.5-year period from the summer of 2020 to the end of 2022, value stocks noticeably outperformed growth stocks by a really wide margin. During this period in calendar year 2022, the FANG stocks that I mentioned before, their stock prices were down anywhere between 40 and 60%. And so our clients, patient long-term investors, were rewarded for that value tilt in their portfolio. And you can see on the far right of this graph what's happened in that valuation spread between growth and value. Value stocks' substantial outperformance has narrowed that valuation gap with growth stocks rapidly. We haven't seen a rotation from growth to value like we've seen the last 2.5 years since the tech market crash over 20 years ago. Now, while the valuation gap has narrowed, growth stocks remain at a valuation level similar to their peak during the tech boom of the late 1990s. So we thought what we'd do is give you an actual view of how this value tilt and the profitability tilt implemented in your portfolio really drove returns in calendar year 2022. So what we're comparing here, if we start at the very top here, you'll see that the U.S. Core Equity Fund, a fund that virtually every one of our clients holds and is one of their largest weightings in their portfolio, was down last year 14.2%. Versus the Russell 3000 benchmark index for the US market was down 19.2%. So our clients saw a full 5 percentage points of outperformance last year versus the benchmark index. And we wanted to walk you through why that is. So what we're graphing here is the whole of the US equity market based on 2 different metrics. On the vertical axis, we're ranking the market from growth stocks at the top to value stocks at the bottom. And you may remember that we favor value stocks, or you're going to be overweight value stocks. And then across the horizontal axis, we're graphing for you profitability from low profitability companies on the left to high profitability companies on the right. So when you think about these tilts in your portfolio, the segment of the market that you're going to be overweight or favoring is that segment of the market that are value stocks with high profitability. So if we start in this right-hand bubble, you're going to see that versus the benchmark index, you were overweight this segment of the market by about 6 percentage points last year. And on the left bubble here, you'll see that that segment of the market last year, its return was only a loss of 12%. That's a 7 percentage point outperformance versus the benchmark index. And as I mentioned before, a really good example of a value high profitability stock, in this case, is Occidental Petroleum, whose stock price was up 119% last year. And you really could insert almost any oil and gas company in that bubble. Now, conversely, let's talk about where you were underweight. So we know we want to be underweight growth stocks and underweight low profitability stocks versus the benchmark. So this upper left quadrant of the market is where you're going to be underweight the benchmark index. It's important to know you still own these companies. You're just underweight them versus the benchmark. So this segment of the market, you were underweight 5 percentage points versus the benchmark. And you'll see that its return was a full almost 20% lower than the benchmark. And a great example of a growth, low profitability company would be Tesla. And their stock price in 2022 was down 65%. So hopefully that gives you a good idea of how these core equity funds are incorporating these 3 different tilts in the portfolio. So now I want to shift gears and show you the historic data for the funds that our clients own. And what we're looking at here is, let's start at the top. We're looking at annualized returns across these 3 different time periods. We're starting with that 2-year period, which is that period really since that value tilt took hold. Then we're looking at 10-year annualized performance. And then what's the annualized return of the fund you own since inception in comparison to an index fund that tracks that same benchmark index. And then finally on the right, what we're showing you is what is the inception date for the fund that our clients own. So you can get a feel for how long is that since inception performance. And in the cases here, you can see that that's 17, even up to 30 plus years, these funds have been in existence. So just to walk you through what you're looking at here real quickly, the top number represents the return of the annualized return of the fund that our clients own. The middle number represents the annualized return of the representative index fund that tracks that same market. In this case, it's the iShare Russell 3000 Index Fund. Its ticker is IWV. And then the bottom number represents the delta in performance between those two. And if this number is green, it means the fund that our clients own outperformed the index fund for that representative annualized time period. And if it's red, it means that it underperformed the index for that time period. So one important thing to remember about performance versus the benchmark index is that over a 10-year period, historically, only 25% of all managers outperform their benchmark index. And if we looked at a 20-year period, which would maybe be more representative by the since inception numbers, only 20% of all managers outperform their benchmark index. So historically, over the long term, investors have only had a 1 in 5 chance of picking a manager that over the long term would outperform their benchmark. Now, if we shift to looking at other sectors that we invest in, like international and emerging market equities and global real estate and bonds, we're sharing with you the exact same comparative data. And we think there's 4 key takeaways for all investors to take here. First is that you must be different than the benchmark to beat the benchmark. And if you are different than the benchmark, any difference will drive short-term periods of underperformance and outperformance, just like we've seen in the last 5 to 6 years. But investors who want to capture the premiums our portfolios are designed to deliver must have a disciplined long-term approach. And those that have maintained a patient, disciplined exposure to these areas of the market with higher expected returns have benefited nicely over the long term while they've worked with us. So just a reminder, when you think back to those odds, you see a whole lot of green on your screen here. And in fact, there's only one fund for one short period of time that has slightly underperformed its benchmark index. So we could not be happier with the portfolio performance our clients have experienced while working with us. And with that, I want to pause and open it up for questions. Jake, what type of questions have we had come through?
Yeah, Mike, we've had a few questions come through. The first one, and I'll just read this word for word, is for the standard deduction, married filing jointly, does the over 65 bracket apply if only one of the couple is over 65, or do both need to be over 65? And so the quick answer to that is the person who is over 65 receives the additional standard deduction, but the spouse who is under 65 does not. So you'll be right in between that, married filing jointly standard deduction and the married filing jointly over 65 standard deduction.
Okay, so you get kind of half of the step up.
Yeah, half of the step up. Okay, that's exactly right.
Well, that's a great detailed question to start us off with today. Anything else come through?
Yeah, we had another question, Mike, on wouldn't Netflix have large assets in film properties? And I think this came from your example of Netflix as a growth company. And so when we think about Netflix, certainly can't claim to know their exact assets and film properties, but Mike, what comes to mind for me is that while they might have large assets in film properties relative to the price of the stock, it is still a growth stock. So when we think about Netflix, its price to book ratio was at 17 at the beginning of 2022. And that would have been off the chart of the example you showed of relative valuations for value and growth. So you can add some thoughts there, but
Yeah, it's great. So let's actually compare and contrast Netflix with Disney.
yeah,
Right. So Disney would have been a value stock. Stock was punished, but think of the billions, actually the tens of billions of dollars that Disney has spent to acquire different media companies and their film libraries. Netflix, at least up until this point, has done none of that. They've certainly invested in some. Most of theirs are going to be much more lower budget type of productions. Disney would be a great poster child of the opposite of that. A lot of assets, a lot of capital invested in that segment, and a much lower stock price. So that's a great question.
kind of switching topics here. We got one more question that we can kind of take high level or go more in depth on, but it was, how does the value and growth weighting of an ESG core fund compare to the weighting of a non-ESG core portfolio?
Oh, that's a great question. So ESG, just for everyone that's listening, would be oftentimes thought of as like a sustainability portfolio. ESG, I believe, stands for environmental, social, and government governance. Thank you, Katie. So in our world, we think of those as like sustainability portfolios. So these are going to be portfolios that are going to have a very specific tilt to companies that on different metrics rate quite highly for sustainability. So the question was, how do their tilts differ? So the tilts in aggregate are going to look nearly the same. Okay, where you're going to see some differences in aggregate, like at 30,000 feet, those tilts to small, to value, and to profitability are going to be, they're the exact same core principles that are being implemented. Now, where you will see some noticeable differences is if we look at just the last few years. Obviously, that ESG sustainable portfolio is going to be underweight or even completely eliminate a sector like oil and gas, right? Because of the sustainability issues with oil and gas companies. So while those tilts are going to be the same, the implementation might be a little bit different, whereas oil and gas companies were a big heavy value tilt the last few years. That sector, if you will, is going to be lighter in a sustainability fund. But that's going to just come down to some real nuances at the sector level. So another great question. Again, please feel free to continue to ask questions. Just make sure you enter them in the chat bar, run your mouse across the bottom of your screen, click on the chat icon, and enter your questions.
All right, great. So thank you, Mike. This is Katie, and I get the opportunity to share with you today, the easy opportunity to talk about what's happening next. Okay, well, not so easy, but as most of you have heard us say, probably more than a few times, we don't time markets here, and we're not going to start timing markets today. I'm not going to make any forecasts or predictions here. But saying that we were moving into 2023 completely blind would be a misstep as well. I think the saying goes, while history never repeats itself, it often rhymes. So we have 95 years of research quality data on stock returns. In these 95 years, we've seen a market decline of almost 50%. We've seen a geopolitical crisis. We've seen global war. We've seen a global pandemic. We've seen Republicans hold the presidency, House, and Senate. We've seen Democrats do the same. We've seen the Eagles actually win a Super Bowl. Too soon? Too soon? Okay. All of these major events were not only lived through, but companies found ways to innovate and create a profit. Markets have moved up and to the right. They've always recovered from corrections and have appreciated to new heights. So instead of making a prediction based on what maybe happened in the last 1 year or even 2 years, let's take a deep dive and use decades and decades of data and leverage empirical evidence to help us understand what has happened when markets have declined, similarly to how they declined last year. So what you're looking at now is a very busy table. This table has collected every time since 1940 that the market has been down at least 25%, and then the subsequent returns that ensued. Why is this important? Because at one point last year, the market was down about 25%. So this is our most comparative data. So let me break this down for you. We'll start at the very left-hand side of the table in the red boxes. This is a list of every time frame when we saw at least the 25% decline. So remember, we're starting here with COVID, then the financial crisis, and we go to the tech bubble burst, and then of course, Black Monday, and et cetera, et cetera. The next boxes over are the blue boxes. This shows the average number of months from the market peak to the 25% decline, and then the 25% decline to the actual bottom of the financial crisis. Well, that's interesting. We're not going to focus too much on that or the total market decline, but rather what you might be asking yourself right now. What were the returns after a 25% market decline? Let's look at the averages here. Both the 3-year and the 5-year averages after a 25% market decline are not much different than what we would expect the market would give us over the long term, about an average of 9.5 or 10%. And remember, that's an annualized rate of return, so that's year over year. But where that data might surprise you is maybe what happens on average in the first year after a 25% market decline. On average, over the last 7 decades, the market has been up 20% in the first year after a 25% market decline. Now, if you look, that doesn't happen every time, but you can see there are some big years of appreciation here. Simple takeaway is you've got to be in it to win it. Often when markets are most uncomfortable is when we see the most promising potential ahead. Because remember, when prices decline, expected returns rise. Okay, now that we've talked about equities, let's think about bonds. If you thought that equities were volatile last year, bonds were almost just as volatile. We just had the worst bond market in our history because of the very dramatic and fast rise of interest rates by the Fed. So after a year like that, what might we expect moving forward? Consider the graph on your screen now. This is a case study that looks at the growth of a bond fund with a 5-year duration. Now, for a bond fund, think of duration as the average of time to each principal payment of the underlying bond in that fund. So again, the graph is looking at a 5-year duration bond fund, which, by the way, is very similar to the bond fund that our clients own in their portfolio. And it's looking at an investor with a 20-year investment timeline who has invested $100,000. Now, the first scenario graph is represented by the blue line. The blue line shows us the growth of a bond as if rates never changed last year. So the investor had $100,000 at the beginning of 2022, and that $100,000 is growing at a 1% yield over the course of the next 20 years. Because remember, at the beginning of 2022, the Fed funds rate was around 0%, so bond yields were very low. Now compare that scenario to the second scenario, which is graphed by the green line. The green line shows the investor going through a rapid increase in rates like we did last year. So in that type of environment, what happens? Well, remember, when rates go up, bond prices go down. So you can see here in the green scenario that the yields are higher, but the investor has also suffered a principal reduction to their starting $100,000, which made their starting $100,000 more like $85,000. So which scenario is better? Well, it depends. How much time do you have? You'll quickly notice if this investor needed to sell in the next 5 years, she would incur a loss. However, if you're a long-term investor, then last year's pain is actually much better for your long-term gain. And that's the point. The amount of time that you'll be invested must be further out than your average bond's duration. If it's not, then you're a saver and you should think about a different investment vehicle, something like a high yield savings account or a one-year bond fund. But if it is, you're an investor. You should put your money in a bond fund that allows for more market-like exposure and potentially higher return. But there is a sweet spot here. You don't want to push out your time horizon too far. For example, last year, the 30-year Treasury bonds were down around 30%. That type of principal reduction is likely to never be made up again. Those bonds act more like equities than bonds. They open up the door to too much interest rate risk. Your bonds are not meant to provide big moments of growth in your portfolio. The role bonds play in your portfolio is one of decreasing volatility. So there is no need to take extra amounts of risk with an asset class that is unlikely to provide the type of equity market returns that equities can. All right, so to sum up the last two slides, in a lot of ways, our outlook for markets is more positive than it was at the beginning of the year last year. This is not to say that challenges aren't certainly ahead. We're facing very disturbing situations around the globe. Many risks still occur, and we don't mean to come off unempathetic to the real-life challenges of war and inflation, political unrest, massive layoffs, etc. However, markets are unemotional, and after reviewing robust amounts of data, our outlook for markets is positive over the long term. So you might be asking yourself, well, what if our economy moves into a recession? Would our outlook change then? Well, I'm glad you asked. So if you read any new publications this year, or just read any of those media alerts that pop up on your iPhone, you know that just about every economist, journalist, financial prognosticator, doctor, and barista is talking about a possible upcoming recession. So what does that actually mean for you and your portfolio? Introducing my third busy graph for you today. What you're looking at here is the S&P 500 declines or drawdowns from 1947 to 2022. Let's review again. 1987 Black Monday, early 2000 tech bubble, financial crisis, etc. But what makes this graph really interesting are the added gray boxes and the red line. Before I explain those, let me explain to you who the NBER is. The NBER is the National Bureau of Economic Research. These guys are the guys that formally announce a recession. They monitor the data and then make a public announcement of recession start dates and end dates. But the tricky thing is a recession is not announced until we're already in it. Because economics is mostly backwards looking. Economists are looking for a matrix of key indicators, not just 2 quarters of negative GDP numbers, but a matrix of indicators like inflation numbers and GDP figures, unemployment numbers, etc. But remember, all of this activity is from our past. Okay, so now back to the graph. The gray shaded box is the recessionary time frame, and the red line is the moment in time when a recession is actually announced. Notice every single red line on the graph is after the recession is already well underway. In fact, since 1979, when the NBER started announcing recessions, 6 recessions have been announced, and on average, the date of that announcement came out 10 months after the recession had already started. And here's the crazy part. On average, recessions only last about 10 months. So big takeaway here, recessions are often over before they're ever even announced. Okay, so why does this matter for markets? Well, let's think about that for a second. Markets are forward-looking. They focus on future cash flows of a company, and millions of investors every day are determining a fair price for a company's stock based on what they know today and what the future looks like for that individual company. Therefore, the market is pricing in the recessionary economic trends in real time, and markets have likely priced in a recession far before it's ever actually labeled a recession. Again, because NBER is looking at trailing economic data. Let's use the financial crisis as an example here. The market at the bottom was down 55.3% March 9th, 2009. The NBER did not announce we were in a recession until the beginning of March that year. The market had been pricing in a recession for more than a year before it was announced. And if the equity investor would have been spooked by the recession announcement and made a major change, they would have then missed the single best market recovery in our history. Because what this slide is telling us again is markets are forward looking. The market recovery begins long before we see positive growth in the economy. Warren Buffett famously said something along the lines of, even if I knew exactly what the economy was going to do, I couldn't tell you what markets were going to do, because economies and markets don't move in lockstep. So if you do end up hearing sometime this year that we're in a recession, historically speaking, that could actually mean positive performance is up ahead for you and your portfolio. Okay, one last time, why? Because number one, the market prices in a recession before it happens. And number two, the market recovery begins long before we see positive growth in the economy. All right, lastly, after so much detail, I just wanted to zoom us out for a second. You've seen this graph from us before. It's graphing the growth of $100 over that 95 years of market data that I spoke to earlier. So let's use this as a lens to think about another recent headline that has spooked some investors. The impending debt ceiling crisis and the negotiations between parties to raise the debt ceiling so the United States doesn't default on their debt. It sounds like a pretty serious situation, and it is. I'm not arguing that, but what if I told you that the debt ceiling has been raised, extended, or revised 78 separate times since 1960? And that this has occurred 49 times under Republican presidents and 29 times under Democratic presidents. In 2011, there was a lengthy standoff, and it led to the first ever U.S. credit downgrading by Standard & Poor's. Markets reacted negatively, and it was another scary moment for some investors. However, looking at this very long-term graph, you can't even really see 2011 or make out that market frenzy. The point is, markets go up and markets go down, but if you stay the course and you're a disciplined investor, the growth of your $100 is likely to be worth a whole heck of a lot more tomorrow than it is today. All right, I'm going to pass it over to Livia now. She's going to personalize the data that Mike and I shared with you today as she talks to why this is important to you.
Thanks, Katie. I understand that I am the last thing between all of you and perhaps a Valentine's Day lunch, so I'm just going to cut to the chase here. And you may still be wondering, so what does this really mean for my portfolio? Which is a great question. So I want to bring it all together by getting granular and walking you through a real example of a portfolio that we have managed for 20 years. This will really help you quantify the actual experience our clients have working with Aspen Capital Management. This is a graph showing a 70-30 portfolio. So this is this is actually the most common asset allocation across the portfolios we manage. It's 70% equity exposure, 30% bonds and cash. It would be considered a moderate risk tolerance. And what you'll see here is the starting value of this client's portfolio at $100, to give the example. It's the same thing Katie walked through in terms of the growth of the dollar in the market, but this is in the context of a portfolio that we manage for a client. Now, what makes this graph really interesting is it's a 20-year investing history with Aspen Capital Management. So you'll notice down here in the lower left-hand corner, an inception date of early third quarter of 2003. Now, it's really important to note that each client's return and investing experience will be unique to their inception date, which is when the assets are actually invested with Aspen Capital Management. Now, hindsight's 2020, right? So we look back and we would take a look at this graph and say that this portfolio performed as we would have expected it to. Over time, the value moved up and to the right. So the short version of this story is the client continues to meet their goals in retirement and they are thriving. But what did it actually look like along the way, given all that can transpire over 2 decades? To really give you a sense of what was going on in the equity markets, and in tribute to Valentine's Day, I plotted pink dots for the years when the S&P 500, which is the 500 largest US companies, saw declines of 10 to 19% on an intra-year basis. And the red dots are plotted to show even deeper intra-year declines of 20% or more. So note that there were 20% or larger declines just in the last 5 years. And you'll notice this client, if we look at $100, started with $100, somewhere around 2009, 2008, their portfolio had actually halved. So it had gone almost to 200 down to 100. And yet they stayed the course and continued to benefit from also some of the surges that happened in the market, in addition to some of those declines. And the key here is, despite weathering 2 recessions and several very temporary declines, our client acted on our coaching and advice to stay invested. Their discipline and consistent behavior led to positive outcomes as the market recovered. It's not to say it was easy to maintain this level of commitment for our client, but it was a little easier because they relied on us as their financial partner. So the most important takeaway for you is this: market declines have always been temporary. As long as you're a long-term investor, it isn't about timing the market, but time in the market. So how did the temporary declines and ever-present volatility impact wealth over time for this particular client? And the outcome reminds me of the now famous Stanford marshmallow experiment about delayed gratification, where essentially researchers told the children they had the choice of one small immediate reward or 2 rewards if they were patient for a period of time. So much like the patient child in the picture waiting to receive 2 marshmallows, this client too was patient and avoided any reaction. Essentially, they stayed focused on their goals and strategy. They focused on what they could control, which are things like rebalancing when appropriate, tax loss harvesting when available, and always utilizing their plan. The key is they used patience and discipline and were rewarded by starting with that $100 value and going all the way up to $350 value, or you could look at it as $1 million portfolio growing to 3.5 million, which is a 3.5x return. So the lesson this client gives you is simply don't reach for the proverbial marshmallow early. Rather, stay disciplined, maintain your target allocation, and use the long-term benefit of the premium tilts over time. And remember, the financial plan is your best decision-making tool when it comes to making financial decisions, such as when do you retire, how much can you spend in retirement. So I want to give you a couple of examples. When your plan is in the purple zone, this is really where we help you identify priorities and trade-offs, perhaps reduce spending, increasing tax-deferred savings, or deferring expenses. When your plan's in the green zone here, you've got a great balance between saving and spending. You can decide how you want to prioritize spending versus leaving a larger inheritance. And when your plan enters the blue area, this is really where you've chosen to leave a larger legacy to your heirs. So the key point is your decisions are guided by an objective plan that is informed by your chosen goals. And we are here to help you consider and evaluate these decisions year over year. So I will leave you with this key list of 3 critical things that help you become a successful investor. And that is never, ever, ever disrupt the compounding. 2nd, act continuously based on your plan. And 3, control what you can control, because the most reliable way to capture your expected target average annual return is to ride out the frequent, but historically always temporary declines. And with that, I see we have more questions coming in, so I will turn it over to our moderator, Jake. What is our next question?
Yeah, we had a couple questions, and actually going back to some of Mike's slides. So if we want to flip back to those, Mike, the first one we had was our returns that you just reviewed net of management fees, and specifically talking about these long-term historical returns.
Okay, so I think we're on this page, right?
That's
or
exactly
these 2
right.
pages.
Yeah.
Okay, so one important thing for all investors to know is that you always have 2 fees. One fee is the what James talked about, which is the reducing management fee, or it's oftentimes called an expense ratio. And the expense ratio is what the asset management firm, or call it the mutual fund or ETF company, charges to manage the fund. So everything you see up here is going to be net of, so all of the DFA fund performance is going to be net of their expense ratios. And where we have an iShares index fund, it's going to be net of that index fund expense ratio. Now, the second fee all investors have is their management fee that they pay to the advisory firm. Okay. And none of these are going to be net of the advisory fees. They will all be net of the mutual fund expense ratios, but not the advisory fees. The big reason for that is every advisory firm tends to charge based on assets under management. So on a percentage basis, different clients' fees will be different based on the size of their portfolio. So it would really be impossible to do this across a broad swath of clients, net of our advisory fees.
Mike, the other question we had come in was also on these historical performance slides. And it was about what does the 1 year view of this look like? So looking back at 2022, specifically instead of just that 2 year view.
Yeah, so the numbers are in many cases even wider, and that's driven by the outperformance is even better over a 1 year period, and that's driven primarily by this right here, right? Those tilts were exceptionally strong last year. I chose 2 years just to show kind of that full period. Every one of those was, not every one, all but one was green over the 1 year period, just like all but one was green over the 2 year period.
And I'll just chime in there really quick, Jay. This is Katie. That is something, if you're curious about that, we're doing that in every one of our annual reviews for our clients. So we look at that 1 year performance and really specifically relative performance between each asset class for our clients, looking at how the fund that they owned performed versus the benchmark in the last year. So if you're curious about that, get with your advisor and schedule that annual review. You know, when we send out your reminder to, we can work through those figures to give you that 1 year figure or 1 year numbers on the performance.
Great. Well, those are all the questions that we had come through for the section. Is there anything else that anyone on the team would like to add?
I was just going to leave folks. I know we're a couple of minutes over, so thank you everybody for hanging with us a few minutes late. Just a couple of final thoughts. One, I wanted to congratulate Katie and Rachel again on becoming owners and partners in the firm. Please take a minute to congratulate them the next time you interact with them. Second thing, a recorded version of this webinar will be posted to our website here sometime within the next week. You'll get an email from us that the recorded version is up on our website. If you've got a friend or a family member that you think would benefit from listening to this, please feel free to forward that link to them or just forward them to our website in general. All of our past webinars are recorded and available on our website. Just a quick note, we did 2 of those last year, one very specifically on Social Security and Social Security claiming strategies. And then we also did one on Medicare and some specific advice for people that are either in or about to go into and considering Medicare. I would encourage you to check those out or send anyone that you think might be interested in them a link to our website. And then finally, I think Lavia said this before, if you have any questions that you didn't want to ask today, feel free to reach out to your advisor and we'll be happy to walk you through any questions that you have. But with that, thank you again and happy Valentine's Day.